welcome. Good afternoon. Before we get started on the regular lecture, I was just talking, and some of you were still in the process of logging in, but I discovered something on the Bloomberg site that looks like it might be a workaround for us. All right, well, let me just walk you through it. So what I found here and on the portal.bloombergforeducation.com page is that when you go in here, obviously here are the various modules that they have as part of the BMC. But once I got signed in to the BMC in the terminal itself, even from there, I was able to take it in a normal web browser, not inside a web browser inside the terminal, right? So you had two choices. I don't know if any of you have gotten to that point. And I picked the just inside the web browser, not inside the terminal, inside the web browser. And that worked. It was able to let me go through at least one of the parts of the module, and it showed that I had completed it and everything. And then I was also playing around in here, and it appears that, you know, we can actually, once you're signed in, I think that's the key. You've got to go into the terminal to sign into the BMC and create that account. Once you've done that, you don't have to be inside the terminal itself to continue with the BMC, which saves a whole lot of headaches, because getting into that terminal using the Citrix workspace and all of that jazz is just a royal pain. But this was working for me, and it was playing the videos and letting me scale through this.
Let's hit the menu key to go back to the COUN Country Guide page.
Give it a try.
Now, we'll
I'm going to contact Joy at Bloomberg and see if that is
the Italian government curve, the
correct,
risk-free rate
and make sure that that shows up.
The curve chart
I know some of
illustrates
you
the
have already
real-time
logged in
curves
and
of our
created an
choice.
account. So if
right
one of you
sidebar
wouldn't
allows us to
mind
choose our
trying
curves and
this
the yields or
and
spreads
completing
ratios
one of the
we want to plot
modules, and
on
then
the
let me
y-axis.
go in on my side
It
and
also
look and
lets us
see that it
monitor,
showed up,
analyze, and compare
then we can at least
securities and
verify,
curves.
you know, through
For
experience
single
that,
curves, the lower
that
chart
it does
displays
seem
a
to be
table of
working.
rates for
This
each
will be a
tenor,
whole lot easier.
so we
Plus,
can quickly
it
review
won't
the
tie up the
values
terminal,
from the graph.
right? That's the key thing.
By default, we see the
You know,
yield for the day
you'll be
of
in to
recording,
log
so we
in
need to go
and
back in
create
time.
that account.
So let's click the
But
Modify
short of
button
that,
to
that's
show
all
the
you need to
curves
do.
from the specific dates of May 7th and May
Questions or
29th.
comments?
And click Close. As you can see, the 2-year bond shifted
Okay.
300 basis points.
Let me stop that. You were hearing that audio, right? Okay, great. I still haven't got my my monitoring set up so that I can hear it as well, but that's all right. So let's.
I do have a quick question.
Yeah, go ahead, Kristen.
So, if we're, you might have said this before and I just missed it, but if we're looking to come to your office hours, like what Zoom link do we use for that, or do we just need to email you, or how do we go about that?
Oh, yeah, good question. I've got my personal Zoom room link, and you can use that. Typically, the way I've been doing it is to not leave that open. So if you don't mind, just email me and I'll jump in there. So normal office hours, I think I set those up as 10:30 to 12:15. So yeah, just feel free to shoot me an email anytime. And if that doesn't work for you, you know, we can do any other times as well, pretty much. You know, I've got a fair amount of time in the afternoon after class if you want to just stick around, or we could even set up something on Monday, Wednesday, or Friday as well. Okay?
Okay, awesome. Thank you.
Sure. Okay, so Chapter 5 is kind of a fun chapter. It throws a whole bunch of things together. And this is kind of the sort of material that, you know, when you think of investing, you think of the stock market. So this should hopefully, you know, stimulate some interest and questions and that sort of thing. So feel free to stop me if you have any questions. And here we go. All right, they start off the chapter, And they've mixed a couple of things together here that I want to try to help clarify for you. They talk about two types of private placements, and then they talk about private placements and they talk about private equity firms. Those two things are very different animals. I'm not sure why they decided to start the chapter discussion off talking about those two things, because that's not really the stock market. A private placement is a means of placing a security and issuing it, and a private equity firm is a completely different animal. So I wanted to clarify that a little bit and make sure that you all had a clear understanding of what those two things were, but also understand that that is not really the stock market per se. So let's start off with the idea of a private placement. So private placements are not very different than public placements, other than the fact that the parties buying the securities are typically financially sophisticated individuals and almost always financial institutions. The other key difference between a private placement of a security and a public issuance of a security relates to the regulation required by the SEC. The SEC requires a higher degree of compliance and oversight for a public placement to, quote unquote, protect the public investors, whereas they're making the assumption that financial institutions and financially sophisticated investors are able to discern what's going on without additional regulatory oversight. So it saves the firm some money, and it also gives the firm a different group, a different audience, if you will. So the participants in these are typically insurance companies. Now remember, insurance companies have massive investment portfolios because when they bring in their premiums, they don't immediately pay those premiums out in the form of payouts or claims against policies. There's usually some sort of mismatch. So what they do with those premiums is they invest those things. In fact, that's where they make a sizable fraction of their income, is through their investment portfolio. So insurance companies are huge sponges for new securities, as are pension funds. So if you think of some of the bigger pension funds, TIA, CREF is one of the big ones that soaks up a lot of private placements as well. And then the wealthy individuals, the financially, quote unquote, financially sophisticated individuals. So they avoid, doing an IPO, or there could be private placements even after an IPO of additional securities from a firm. They give the firm a lot more flexibility. And by that, I mean, in particular, if you do a private placement of debt and you have thousands of bondholders, it's very difficult to renegotiate or to transmit private information if your company runs into difficulty. Basically, you have one of two choices: you pay the interest, or you go to court over bankruptcy, right? In a private placement, you've got a third opportunity, and that is to privately sit down with those participants in that offering, because it's a small group, and negotiate some changes to the bond indenture. And that way you might avoid bankruptcy. You're more able to reveal private information that is pertinent to that small group, with a proviso that they don't reveal it to the marketplace. But you can't do that to a public group of investors, right? Because eventually, if there's some information that's sensitive to the competition, or that if the competition got it, it might benefit them, you don't want that going public. So, but if you have a small group of private placement investors, you can make that information available to them and put them under a non-disclosure agreement, something of that nature. And as just a fact of how big is this marketplace? It's pretty big, especially when you look at bonds. 50% of the long-term corporate debt is privately placed. The other thing to know about these private placements is that you and I can still participate in these things indirectly. right? Because this is part of being diversified, right? It has a slightly uncorrelated return series with the other assets that we're able to hold. And the way that you and I can participate is by investing some of our retirement funds, for instance, in TIAA CREF funds or any other of the big pension funds out there. So there are ways of participating. Another benefit that companies find is that the rates that they can enjoy in these private placements are beneficial to the company. So all in all, it's a very big market. Billions and billions of dollars, hundreds of billions of dollars in this marketplace. But you and I can't participate directly in it, but it's still important. Why they put it at the beginning of Chapter 5, I'm not sure. And then to juxtapose it next to private equity firms, which are, you can think of a private equity firm, sure, they're a financial company, but they're a lot more like a hedge fund. There are some very key differences, but actually it's interesting that hedge funds, private equity firms, and investment banks all seem to be converging on each other's territory. So even though there's a hedge fund, they may do some things that formerly private equity firms only did. And investment banks may do some things that hedge funds do. They may even have their own hedge fund. They may even have their own private equity firm within the investment bank. So they're all kind of converging on these sort of activities. But the kind of prototypical activity that a private equity firm would have engaged in is a leverage buyout. So they buy up firms that for whatever reason appear to be undervalued by the market or maybe mismanaged, maybe carrying a lot of excess assets on their books that for whatever reason management doesn't get rid of. So they buy these firms up, kind of polish them up, clean them up, make them operate more efficiently, generate some cash flow in that process, and then turn around 3, 5, or 7 years later and sell them back to the marketplace. So typically these are publicly traded firms, and they are taken private. So the private equity firm buys up all the publicly outstanding equity in the firm, and then they own it lock, stock, and barrel. And then 5 or 7 years later, once the firm is more efficiently operating, they take it back public. They might merge it with another corporation. They might even sell it to another PE firm, depending upon the circumstances. But if you look at this diagram here, so here is the private equity firm itself has a group of general partners, and they own the financial firm itself. Then there's another group, and this is a much bigger group. These are the limited partners, and these partners don't invest in the private equity firm itself. They invest in a fund that is a part of the private equity firm. And the private equity firm may have multiple funds, so there may be another fund over here. Just move this around so I can write a little more cleanly on it. So there may be other funds with other companies over here, and we have another group of limited partners that invest into that fund as well. But all of these funds are owned and operated by the private equity firm itself, and the general partners get profits out of that. Now, those general partners may also have their own cash invested in each of these funds. In fact, typically they do. But they also do some other things. For instance, they might provide advisory services to these portfolio companies, the companies that they have purchased and are making more efficient. So they generate other cash flows that come out of these funds directly to the private equity firm and the general partners, whereas the profits go to this and then eventually flow back to both the limited partners and the general partners. So you can think of the private equity general partners as they're not only are they getting the profits that the limited partners share in, but they're also dipping into a few other cash flow streams out of these portfolio companies. And so there might be anywhere from 5 to 10 portfolio companies within a particular fund, and they'll start that fund up, they'll gather the money together, and they'll go out and start looking for companies that are likely targets. They'll buy these firms up, and then they'll hold them for anywhere. The very shortest period of time is typically 3 years. More likely, it's 5 to 7 years that they're holding them. That's one of the other key things that differentiates, say, a private equity firm from a hedge fund. A hedge fund holding period is much shorter. It's on the order of 1 to maybe 3 years. So it's a very different holding period between these two guys. But that's a private equity firm. They also do some other types of things. So they may provide some sort of financing to other companies. So it's not just the LBOs. And it depends on the private equity firm as to what they specialize in. Some of them may just do LBOs. Some of them may just do some sort of financing to mid-size or mid-cap and small-cap companies. Others may engage in just venture capital activities. And then there are yet still another group that engage in a little of each of these. So they do several different things. Again, remembering that one of the key differences is holding period return. So for instance, venture capital type activities are also long-term activities. It's much longer than the typical hedge fund is engaged in. Their investments are typically on the order of a year to 2 or 3 years at most. So this just goes into a little more detail. I'm not going to belabor it on the types of different investments that private equity funds get involved in. By the way, I put a link here. There's quite a bit of middle market in the way of private equity funds, or private equity firms. So here, if you click on this link right up here in this first bullet point, is a list of some private equity firms right here in Cleveland that you might be interested. If you're interested in this type of work, it can be a lot of fun, and there are quite a few companies right here in the Cleveland area that you could talk to. And let's see. All right, so let's get on to kind of the guts of Chapter 5 here. And there's like a word salad of terms. And we're going to go over, and I'm going to try to help you to disentangle this mess of terms here. By the way, when you look at these slides, if you wanted to figure out what any of these particular terms are, I've made these hot links. So you can actually click on it. It'll go to either like an Investopedia page or a Wikipedia page and give you a better idea of the definition of these terms. So let's start kind of at the beginning, because this is, if we think about the process chronologically speaking, a firm figures out, hey, I want to raise some capital. How am I going to do this? So let's start at that point where the firm has just decided I need to raise some capital because I have a project that I want to engage in that I think has a positive NPV. Well, the first thing they have to decide is how are they going to approach the middle party, the middleman that is going to help them do this offering. And typically that's an investment bank. We're going to talk about how you might even circumvent that investment bank in a little bit, but for the most part, the vast majority of security issuances are managed by an investment banker of some sort. It might be a regional investment bank for a middle market or a small cap firm, or it could be a national type of investment bank. A Goldman Sachs is kind of at the very pinnacle of that list. So the question is negotiated versus competitive offer. I'll tell you to start off with right away, most offers are negotiated. Very few of them are competitive. And we're going to find this over and over as we look at these various terms, when we have a choice between two things, usually the market has focused on one particular direction, and that's the vast majority of these types of offers. So the way a negotiated offer works is that the issuer and the underwriter negotiate the terms of the offer and design the security that best fits the needs of the issuer. So let me put it another way. The company that wants to raise some capital approaches an investment bank and says, look, we need $50 million to do X, Y, and Z. Here's the project. Are you interested in helping us because we'd like your help? So they go to Goldman. Goldman says, you're too small. We only deal with the really big fish. And then you go to another banker and you talk to them and they say, yeah, we'll take you on. And you sign an agreement with that banker. Now, you don't know what type of security you're issuing. You may have some ideas of what you might want to issue, but ultimately none of the particulars or the characteristics of the security issuance are really thought through at this point. You've made a decision to engage with a particular investment bank, and for the most part, you're kind of outsourcing the rest of the activity to the investment banker. They have the expertise in-house, right? So why hire it in your own company when you can hire it through an investment banker? And you don't need these sorts of expertise that often. So why have it in-house? And 90-ish% of the offers are negotiated. So you select the investment bank first, and then the investment bank helps you design the security, design all the other characteristics around that issuance. A competitive offering is a little different in that basically the firm itself, the issuer, designs the security and says, look, we want to issue $50 million worth of equity. It's going to be common stock, and we've already figured out what we think it will sell for in the marketplace. We've figured out some of the characteristics. Now we're going to put that out there, and any investment bank that wants to bid on helping us with this, you're free to submit your bids. We'll select from that list of bids, and we'll go with that particular company. All right. So key differences between negotiated versus competitive offering. Like I said, negotiated is the vast majority of the offerings are negotiated. So we pick the investment bank first. Oh, here we go with primary, secondary, third, fourth markets. What are all of these things? And then not only do we have primary and secondary markets, markets, we have primary and secondary shares. So let's try to disentangle all of that. So a primary market is the market when the securities are first issued. That transference from company or issuer to the first investors takes place in what we call the primary market. And this is the case of an IPO or even a seasoned equity offering. And we'll talk a little more about that in just a minute. But I'm sure you probably all are familiar with the seasoned equity offering, with the IPO, maybe not so much with the seasoned equity offering. So an IPO is an initial public offering. Up until an IPO, the company may be a stock company, but it's privately held. Those shares are not easily traded. They're not very liquid. So if we take it public, that makes those shares much more liquid, allows the founders and the initial investors to sell some of their shares. It allows them to figure out what's the value of these shares by using the marketplace. Otherwise, it's very difficult to ascertain the value of shares in a privately held company. So the key thing, how do you tell whether a transaction is a primary market transaction or a secondary market transaction? Watch the dollars. If the dollars flow to the company, to the issuer, that transaction is a primary market transaction. Okay? If the dollars go from one investor to another, but not to the company itself, that's a secondary market transaction. So the NYSE, the NASDAQ, all the other regional exchanges, ARCA and everything, all of that, the international exchanges, all of those are secondary markets. So they're investor to investor. Now there's a mediation in there. There's the exchange, there are brokers, there are dealers, etc. But the key thing is cash does not go back to the company. The company got the cash on the very first trade. That occurred in the primary market. And any other subsequent trades between investors, cash goes between the investors, but not back to the company. The company's off doing the project that they had originally planned to do. All right, generating hopefully some positive operating cash flows. So IPOs are an example of a primary market transaction. So are SEOs. So if a company has already done an initial public offering, it already has 50 million shares out there trading in the marketplace, but it needs more capital. And their investment banker decides that the best way to get that capital is through more equity. Then they do what's called a seasoned equity offering. Seasoned meaning that the equity is already trading out there. There are already 50 million shares out there. What we're going to do, though, is we're going to issue an additional 10 million shares. So there'll be a total of 60 million shares out there. And again, remember, cash in that case is flowing from the first investors straight back to the company. The company is then using those dollars generated from the 10 million shares that they sold to engage in whatever the positive NPV project is. Any subsequent trades of those same shares take place in the secondary markets. That is the stock exchanges. Okay. Questions on primary and secondary markets?
Dr. Elliott,
Yeah.
would a stock split be considered like a seasoned equity offering, or would that fall in that category?
Good question. Yeah. Stock splits are not a seasoned equity offering. Stock splits are an interesting animal, right? So they take a share of stock and they split it in either 2 or 3 or 4 pieces. Those shares go straight to an investor, and there is no cash flow to or from the company. There's only a flow of shares from the company to the existing investors. So if we do a 2-for-1, which is the most popular type of stock split around, if you hold 1 share of the company's stock, basically the company announces, we're doing a stock split, folks, and for every share you own, we're going to give you an additional share. So if you had 1 share, you will now, after the stock split is implemented, you will have 2 shares. Now, remember, there's no cash flows on these things. This is simply the company issuing an additional piece of paper that says 1 share of stock in company XYZ. So it's kind of a non-event in many regards. And you might ask, well, why are non-events so important and so frequently used? And it's a very good question. There's a lot of research trying to figure that out. One of the answers is that possibly if a share price has gotten to a level that small investors don't feel like they've got sufficient capital to put into that stock. The prime example, of course, would be Berkshire Hathaway, right, at $350,000 per share. As regular individuals, you and I don't have 350 in our portfolios to start with, much less can we focus all of our principal into Berkshire Hathaway. Berkshire Hathaway is fairly diversified, but it's not the market. So we'd probably be better off to put our money into an S&P 500 tracking fund or something of that nature. So that might be one reason for a company to do a stock split. But actually, those really don't fall into any particular category like we're talking about here, because they're not really a sale of a security. They're just an issuance of additional shares, not in exchange for any cash whatsoever. I mean, I guess if you really wanted to categorize them somehow, you could say that first issuance of these new shares would take place in this primary market, and then any subsequent trades would still take place in the secondary market. Hopefully that helps answer your question. But that's a type of transaction that many of us kind of scratch our heads on and are puzzled as to why do firms still do this? Because it costs firms millions of dollars to do this. There are additional fees for listing fees if they have more shares outstanding. There are limitations to the number of total shares that they can issue, which is part of the corporate charter. And in order to change that, I have to go back to a vote of the shareholders, and it has to be a supermajority, usually in many cases, to change that. So they're doing some very strange things that, as an academic, we have yet to figure it out why firms do this. Practitioners will tell you some reasons that they think they're doing that for, but even they, when you start really questioning them in detail, don't particularly have an answer. The other strange thing about stock splits is that when they're announced, there is a significant, on average, there's a significant and abnormal price increase on the order of 2.5 to 3.5%. And again, we academics, students of investing, scratch our heads and go, wait a minute. I gave you $1 and you gave me back 2 50-cent pieces. Did my value actually change? That's the question you have to ask. From an pure economic perspective, that's all we're doing. We're changing the denomination. The total value out there hasn't changed at all. So we could go, in fact, I could go on for a long time on this. This has been part of my primary research interests. But I'll leave it at that for the moment. We can have some additional conversations on the side if you'd like, if we have time. But yeah, it's a very interesting area to look at. There have been fewer stock splits. That's also an interesting trend. And we see more and more companies with share prices well above the 3-digit mark too. That used to be an anomaly. It used to be for 100 years or so that the average share price was $30 to $50, and it would stay that way no matter what. Now we see, companies like Google at thousands of dollars per share. So that's another interesting question. Anyway, thanks for that. Hopefully I helped answer your question a little bit, Andrew. I mean, ultimately, yeah, that first issuance would be still considered a primary market transaction, and any subsequent trades would still be considered a secondary market. But just remember that cash flow rule doesn't work in the case of splits.
Thank you.
Sure. Something else while we're talking about primary market and secondary markets that I also want to try to help dispel any confusion on. There are primary shares and secondary shares. And primary market transactions can include both. Secondary market transactions can only include secondary shares. Okay, so let me explain. A primary share is a share that has never been traded before. And the first trade that takes place in the primary market. And again, cash is what we're watching. The cash goes from the first investor straight back to the company. All right? Those are primary shares. Now, remember when I mentioned IPOs and founders, maybe venture capitalists, initial investors in that privately held stock company, they own shares of stock. Not the company. They themselves, the founding investors, the venture capitalists that invested in the company before it went public, they have shares of stock. Sometimes an IPO will include those shares of stock, and those are secondary shares. So remember the cash flow rule. If the cash generated in that sale goes to the company, those are primary shares being sold in a primary market. If, as part of that primary market transaction, we include shares from a venture capitalist that had previously invested in the company when it was private, or a founder that had invested in the company while it was private, those shares could be sold too. Where the dollars go is from the first public investor to the founder or to the venture capitalist, not back to the company. Those are secondary shares. The importance is that, remember, some of those shares, if they're secondary, the cash doesn't go to the firm, so the firm can't engage in new investments, new projects. Also, another interesting artifact of all of this is that there's some research that goes way back into the 60s that looks at what if a founder wants most of their cash out of the firm when they go IPO? That's usually a very bad signal to the IPO market. If a founder is checking out, saying, hey, I'm taking my cash, going to the beach, drinking margaritas or whatever, that's a bad sign to the IPO market. So what we find is that many founders keep at least 40, 50, sometimes just 51% so they can maintain some sort of control. So think of Zuckerberg, right, with Facebook. Zuckerberg still maintains majority control of the firm. Why did he do that? Part of it is to send a signal to the IPO market that, hey, I'm still here. I'm still doing what made this firm valuable, what made you interested in the IPO, and I'm not going away. Secondary shares, while the founders and the VCs want to get some of their capital out, they don't want to take it all off the table because that sends a bad signal and that might lower the valuation on that IPO. Seasoned equity offerings can also include both primary and secondary shares. And some seasoned equity offerings are actually entirely secondary shares. So in other words, no cash goes to the company, even though they are engaging in what's called a seasoned equity offering. So this is typically a very large block holder, and it could be a founder who, once the company is out there trading, says, hey, I want to get rid of this big block. I want to be very transparent to the market, not hiding anything. So I'm going to let the SEC go through their process, and I'm going to try to maximize the value I get for these things. So I'm going to do it as a seasoned equity offering. The company has to obviously agree to this, but sometimes you'll find that SEOs are entirely composed of secondary shares. Typically, it's a mix of both. Typically, the company wants to raise some additional capital for a new project. And so they've said, hey, we're going to do an SEO. And then one of the block holders comes along and says, you know what? I'd like to get rid of half of my position. Would you mind if I threw my secondary shares into that SEO? And if the company agrees and the SEC is fine with it, then we actually have a mix of primary and secondary shares. Now, there's no label on these shares. So when you and I buy these shares, it doesn't say secondary or primary. But this is just a way of thinking about what these shares are. It doesn't matter to the public. It does matter to you and I as students of finance and investing. All right. And then the last two terms on this page, third market and fourth market trades. These are relatively new types of terms. It used to be that all trades took place on the exchange. And then we started innovating. We said, you know what? The exchanges are charging way too much. Let's try to figure out a way to reduce the costs, right? That's one of the key things that we do in finance, trying to keep those costs down, lower transaction costs. So a third market is a off-exchange trade with a broker-dealer. So there's still a middleman involved in this. There's still a broker or a dealer, but it's not traded on the exchange itself. And then a fourth market trade is also off the exchange, but there we've even gotten rid of the broker-dealer. We're actually trading with other investors directly. No intermediation. Now, we don't know who those other investors are. It doesn't really matter, right? We just decided we're going to put our shares in there. If we want to sell, we put our shares in there, and we've agreed to the terms of the trade in advance. Usually there's one price that clears the market, and we've agreed to take whatever that price is based upon the characteristics of that fourth market, and they vary a little bit, so I won't go into the details of it, but that's a fourth market trade. Very, very, very low costs. It also, both of these markets also allow the investor to hide a little bit. So if I know some information and that information might impact the price of the shares, if the market finds out it's me trading, I might go to one of these third or fourth markets and I'm better able to disguise who I am. I can hide amongst the other traders and nobody will find out that information, at least not immediately. So there is some sort of trade-off here we're making between market efficiency. Remember, market efficiency is getting all that information impounded into the price as soon as possible versus minimizing transaction costs and some sort of rent seeking, if you will. Rent seeking being, a better informed trader taking advantage of their position. So there's a trade-off here, and there's still quite a bit of debate about whether there are some terms that are now used, dark pools. If you've heard of that, a dark pool is oftentimes a third or a fourth market transaction. And a dark pool is just that. Nobody sees what's going on inside there. Nobody knows who's in that dark pool. We're just trading these shares. So we're kind of like going around the back of the exchange saying, hey, you want to make a deal? If you will. All right. I think that pretty much covers primary, secondary, third market, fourth markets, primary shares, secondary shares, and we're just getting started. Questions?
Yeah, I have a quick question.
Yeah, Spencer, go ahead.
What would an example of a previously issued security be?
Oh, any shares out there that are trading right now, whether it's IBM or Apple or GM, those shares are already in the marketplace, so those are secondary shares. Any other questions on these terms? Like I said, we've got more to cover. We're just starting.
I guess just for just to be crystal clear, like the secondary examples that you just stated, could you give an example of like third and fourth market like transaction?
Sure.
Because you said it's not directly from the market, so I'm just wondering like who's it between? How's that kind of really going down?
Sure. Well, let me also clarify, all of these third and fourth market trades are secondary shares. All right. So it's just as though you submitted an order to your broker. And in fact, you could do this. You could say, hey, I want it to trade on this exchange, this third market exchange, or I want to trade in the third market. I shouldn't use the word exchange there at all because it's not on a formal exchange like the NYSE or the NASDAQ. I want to trade this share in the third market. And here's, I'll try to give you an example. I can't tell you a particular name of the market that I'm thinking of right off the top of my head. But so what you could do is you could say we might have a third market trade where they take the closing price on the exchange where that security is traded. So let's say it's traded on the NYSE. So we take the closing price on the NYSE, and that's where all trades transact at the closing price. So what we might do is during the day, we submit our order to sell, and we want to sell 10,000 shares. And when we've submitted that order to this third market, we have a priori agreed to accept whatever the price is on the closing of the market for that stock on the NYSE. And all shares trade at that price. Now, whether there's if there's a broker involved in there, then we could have a slight mismatch in the number of buy and sell orders. If there is no broker, we still have to have a match between the buy and the sell orders. So the broker can kind of soak up some of the disequilibrium between the orders submitted, the buys and the sells. Does that help a little bit, Brett?
Yeah, that clarifies it.
Okay.
Because I guess I was foggy on the fact that like third and fourth market operations fell under the umbrella of secondary markets, so that kind of cleared the air right in the beginning.
Okay, good. Yeah, here's another interesting thing, and this is still hotly debated. It was even more hotly debated, say, 10, 15 years ago. And this is market fragmentation. So the whole idea of, or the concept behind market fragmentation is, it used to be that when you had a stock that was traded on the NYSE, there was one place to trade that stock on the NYSE. The nice thing about that is that there was also, and we're going to get into more detail about specialists and DMMs in just hopefully before the end of class here. So there was usually one person that would see all the order flow, the buys and the sells coming through on a particular stock on the NYSE. So that person could get a pretty good idea of where price might be moving. And as a result, they could help to move that price there more quickly and make a more efficient price. Remember, if market efficiency is one of the key things we're always going to come back to, that concept. So if they could see all of that volume, all of that order flow, as we call it, then they could tell more directly what a fair price was for that stock. Now, if we start fragmenting and we've got a third market that trades, they're kind of stealing the price off the NYSE, if you will, to some degree, right? Because they're not contributing to the order flow. They're not helping the specialist on the NYSE floor to determine the fair price. They're just observing that price and saying, hey, we'll go over here and trade at a lower transaction cost. Right? Fourth market, the same thing. And it also has occurred because it used to be that the market would open at 9 o'clock and it would close at 4, right? So now the markets are open 24/7 around the world, in many cases. So that's fragmenting order flow as well. And there was a concern that price efficiency and market efficiency would decline substantially. So far, and it's difficult to do the research on this because it's difficult to find the counterfactual, of course. But so far, most of the research suggests that no, in fact, market efficiency is still pretty good. That's still a relatively hotly debated topic, though. All right. I think I've talked about all of this stuff here on this slide about IPOs and SEOs. Oh, one thing I missed or haven't mentioned yet. When we do an SEO, when we do a seasoned equity offering, we have two types of offerings that we can do. One is referred to as just a general cash offering, and that general cash offering goes to the entire public. So we take out a big ad and we say, hey, we're selling additional shares of IBM or Apple or whatever, Ethereum. And actually, Ethereum is another thing we'll touch on. They might do an ICO, right? But nevertheless, so they take out an ad. It's public. Anybody can sign up or subscribe to this issue. And they may get an allocation, and in which case they buy it. If they don't get an allocation, then they can still buy it in the secondary market. Another type of seasoned equity offering, though, is known as a rights offering. It's a little bit cheaper to do a rights offering, and that's because instead of selling this to the general public, what we do is we just go to the existing shareholders and we say, you know what? You own one share of our stock. I'm going to give you the right to buy 1/10 of a new share. And that way, if you buy that share, you get to maintain your percent ownership and your percent control of the company. So that's beneficial to the investor. Now, the investor may not want any more stock, in which case they decline to accept that offer and then they just keep what they have. Now, let's say instead of just having one share, let's say that particular investor actually had 10 shares. So if they get the right to buy 1/10 of a share with each share, if they have 10 shares, they have the right to buy one brand new share. And again, that cash goes from that investor straight back to the company, and then they invest in a new project, presumably a positive NPV project. That's called a rights offering. Once that investor bought those shares, then they can trade in the marketplace in the secondary market to anybody. The reason for a rights offering is it's cheaper. It allows the current investors to maintain percent ownership quite easily if they want to, and percent control, voting rights control. The interesting thing, though, is that in the U.S. market, the vast majority, just like when we talked about negotiated versus competitive offers, the vast majority of SEOs are general cash offers to the public. Again, it's like a 90% are general cash, 10% or so are rights offerings. What makes that even more puzzling is that if you go over to across the Atlantic to the UK, another highly developed, very efficient marketplace, the reverse is true. 90% of the offers are rights offerings, and 10% of them are general cash offerings. Again, research still has not completely figured out why there's a difference between those two. Just know that there is, and also recognize what the difference between a general cash versus a rights offering is. General cash is to the entire public. Rights offering is just to the existing shareholders. Okay. Now we can go on to the next two terms that easily get confused. Firm commitment versus best efforts. They sort of say that. The name of them is, you can take it from the basic definition of a firm commitment. Well, I'm committed to this offering. Or I'll just give it my best effort. That's basically the difference between these two. So this is an agreement between the issuing firm and the investment banker. And in the one case, the investment banker says, yep, I believe in this offer. In fact, I believe in it so much that I'm going to buy all the shares from you, give you cash, and then you can go about running your project and doing what you do, making an operating profit and all of that. And I'll worry about selling them. I'll find somebody to buy these shares. You don't have to worry about it. A best efforts is the underwriter says, well, I'd be willing to help you price these shares. I'd be willing to help you design the issuance and all the other details, file the SEC paperwork, do the legal work and all of that. But you know what? I don't want to buy the shares myself. I'll help you sell them. I've got this great distribution network, and I'll give it my best effort. But I can't promise you that I'm going to sell all the shares. We'll just give it our best effort. Again, vast majority of issuances are firm commitments. And much smaller are best efforts. Another conundrum here. Firm commitments are more expensive. Why do firms choose the firm commitment route? Well, maybe it's more efficient for them, right? They don't have to, if they've got a project where they need $100 million to do it and 90 million won't do it, then I reduce my risk by saying, hey, you investment banker, you buy all these shares for $100 million. I walk away, I do my project. I don't have to worry about it. If I do a best efforts, maybe I only raise 80 million and I can't do the project with 80 million. So now what am I going to do with that 80 million? I've already issued the shares. Got a problem. So maybe that's the reason. But recognize that there is, again, kind of a lopsided distribution when we look at these types of activities, at least in the U.S. market. So that's firm commitment versus best efforts. I think that's pretty much it, unless there are questions. All right. Let's see, I got about 15 minutes. I think we can get through at least these types of offers, maybe jump into the structure of the NYSE and some of their participants. So here's an example of an IPO. So suppose we have a currently privately held corporation and they want to sell 100,000 shares of their stock at $1 per share. We have 50,000 shares that you own. 50,000 shares were bought by other people, but it's still privately held. The company has prospered, and now we want to go public, so we hire an investment banker to do the IPO. And the investment banker says, look, first off, we did a negotiated deal with the investment bank, so now the investment bank is advising us. So we currently have 100,000 shares. The investment bank says, you know what, I think 4 million shares is the right number, and we will convert your 100,000 shares into 2 million of those 4 million shares. So basically, the underwriter is putting a value on the existing shares. And so those are going to be secondary shares when they're sold as part of the IPO, if we sell some of them. But there are also an additional 2 million shares that we're going to sell straight to the marketplace, and the cash is going to go back to the company for new projects, new investment. And then, again, this is a firm commitment, so the underwriter, the investment banker, that is, agrees to buy all of the shares. And they agree to pay the company $10 per share, but the company knows they're going to take them to the market and sell them for $11 per share. Is that expensive? Yeah, it's 7 to 10% on average. Not this particular example. That's obviously 10%, but typically it's actually 7%. And so, yeah, that is kind of expensive. And again, it's hotly debated as to whether that's the investment bank scamming companies out of 7 or 10% of their rightful cash flow, or are they providing a valuable service? We're going to watch a video in just a second, and basically the essence of that video is that it's a scam. I don't necessarily agree with that, but I do want you to hear kind of the take of that side that suggests that it is a scam. So as the company now is agreed with the investment banker to sell 4 million or to create 4 million shares, they're going to sell 2 million of new shares and then some portion of the existing 2 million shares that are held by the founder and the friends and family and venture capitalists. So then they have a few other choices to make. So they have to choose, obviously we've already said they've chosen the fixed commitment, but then they have to go through a regulatory process. They create a prospectus, which is a document that kind of lays out, here's what the company is, here are the risks we see within this company, here are the benefits of the company, kind of lay out all of the particulars. And then the SEC gets a look at this prospectus, and it takes them a while to approve it. They usually go back and forth with the company multiple times saying, hey, what about this? What about that? What about this? The company responds. In that process, that prospectus does get used, but there's a big red stamp on the front page that says preliminary, not approved by the SEC yet. And the term red herring gets used to describe that prospectus. It's kind of a preliminary. It's a draft, if you will. It's going to change probably as there's back and forth negotiations between the SEC and the company. While that red herring is in existence and before it gets finally approved by the SEC, the investment banker does what's called a roadshow. How many of you have heard of a roadshow? Anybody? No? All right, so what the roadshow is it's the investment bank going around to some of its primary clients and saying to those customers and clients, hey, I've got 2 million plus shares in company XYZ. I'd like to describe that company to you and see how many shares you'd like to sign up for at $10 per share. And so the customer listens to the pitch and they say, you know what, I think I'll pass. Another customer they talk to says, yeah, I'll take 100,000 shares. Another customer says, yeah, I'll take 200,000 shares. So what they're doing is they're gathering information from some of their major customers. These are big financial institutions typically that usually buy shares in an IPO. And they're trying to determine what's a fair price for this. So this is kind of the pre-issue price discovery process. Once we're trading in the marketplace, then the marketplace determines price, right? But prior to getting out there that first time, they're using this, what's called a roadshow, to help them determine price. This is all part of a process called price discovery. In this case, price discovery takes place in very private settings between an investment bank and the investment bank's major customers and clients. Once the company goes IPO, then that process of price discovery takes place in the open market, and we can all observe it. Okay, then finally the SEC approves the prospectus, it becomes official, and then they can advertise the issue to the public. And they take out what used to be known as tombstone ads. Since we don't have any printed papers anymore, I don't think these things even exist per se. I mean, you'll see them advertised, but it used to be that it would take up an entire page of the Wall Street Journal for a really big issue. And so here are the shares, here's the company, here is the expected price per share. Now that's going to adjust up and down right up to the moment when they actually do the issue. But that's the price we think we're going to go at. And the U.S. offering of this is actually only 9.2 million. The other 2 million are going to be offered in other markets internationally. And then we have the syndicate. And the syndicate is a group of investment bankers that are taking this offer to market. So Bear Stearns in this example is the lead underwriter. The lead underwriter is always on the left and always at the top and always in the biggest font. If Goldman Sachs happened to be part of this deal, Goldman Sachs is always, always, always on the left and at the top and then the biggest font. They never take a subservient role. It's just the way they go, I guess. Bear Stearns probably similarly, but Goldman is very much known for that sort of thing. Credit Suisse, Merrill Lynch, Witt Capital all have a substantial role. They may even be co-lead investment bankers in this deal. They're the ones also getting the vast majority of the percent, that 7%. They're getting the biggest share of that. Plus, they're doing most of the work. Then they put together this syndicate of other investment bankers that are going to take a piece of the offering. So, down here, Tucker Anthony, Clary Gull, they're going to probably they've committed to taking 75 or 100,000 shares and selling it to their customer base. And they'll get some fee for that activity, they're basically a distributor, if you will. They didn't have much of a big role in terms of pricing or the roadshow or designing the security, but they're part of the distribution network. Bank of America might have had a slightly bigger role, but they're still part of the distribution network. So all of these folks down here just help to spread out those shares as widely as possible so that we're able to attain that $17 per share price. Okay? Questions so far about the IPO process? This is very high level kind of overview of that. By the way, let me just note, I put a link up here if you're interested in a kind of a timeline. This was off the FEI site, Financial Executives Institute. And so it's a group of CFOs. And so they put together a detailed page of the timeline if you're interested in more details on that. Okay, let me, it looks like we've got just enough time to watch this video. This video is Jim Cramer and Kudlow interviewing Patrick Byrnes. he's no longer, but was the CEO of Overstock.com. He has some rather controversial, shall we say, opinions about the typical IPO process. What he's going to be referring to is what's called a Dutch auction. And we can continue on this on Tuesday and describe it in more detail. But a short version of it is a Dutch auction. Instead of an English auction where we start at a low price and we keep going up until we run out of people bidding prices, and that's who we sell it to. A Dutch auction starts out high and we work our way down. And we find somebody who's willing to take it at that price. It actually is a more efficient means of getting participants to disclose prices, especially when you have multiple things that are identical that you're selling at that same price. So that's what he's talking about here. Like I say, he's a bit of I don't know how I want to describe him. Well, I'll just let you watch him, and we'll talk further once you've seen the YouTube video here. This is a little dated too, so it's like 12 years back.
Our next guest in today's Google Fest is the CEO. This guy is such a hoot. Is the CEO of Overstock.com.
If you've seen Cramer lately, his hair is quite a bit.
This is Patrick Byrnes, the larger-than-life Overstock.com CEO. Patrick, given the fact that PET, which also worked, and Overstock came public this Dutch treat way, I mean, can't we just say, what the heck? It's certainly better than the way that they did it before.
Absolutely. This is hands down a better system. It's a better mousetrap. It's not ambiguous. It doesn't trade anything off. People are going to look back in 3 years and say, how did the conventional Wall Street system last as long as it did?
Why is it so much better?
Well, because the conventional Wall Street system is corrupt.
Right. Thank you.
Yeah, well, it is corrupt.
Well,
you know, Jim.
I thought I was the only one who ever said any stuff like this. Yeah, I hope my dad's watching. I was throwing the rocks. Like, go ahead, man.
Why is this better?
I can explain it in 3 points. First, as a general principle, anywhere in human affairs that there's guaranteed profit to be allocated, there's kickbacks. Doesn't matter if you're talking about some third world customs official or a white shoe Wall Street banker. It happens. Secondly, the conventional system guarantees profit. They get the heat going about the stock, then they underprice it, shovel it to their buddy in some sleazy hedge fund.
You gave a Lexus example once.
Yeah, well, it's true.
Again.
You guys always cut me off when I start talking.
No, you got the ball.
Okay, if I had a Lexus, no, you have a Lexus, Jim, and it's a $30,000 Lexus. You hire me to...
No, it's actually 60, but that's
okay, $60,000 Lexus, you hire me to go sell it for you. I take it out, and I sell it to a buddy of... You hire me to go sell it. I sell it to a friend of mine for $30,000 instead of 60, then he turns around and sells it for 60. You know, have I defended your interest?
No.
And now
That's what Wall Street does all the time.
So what they do all the time, and now what if it turned out that my buddy actually had me come over the next day and I mowed his yard or something, gave me 10 grand to mow his yard? It's clearly a payoff. That's how the whole system works. So the Handbrake system, because it's an auction, doesn't allow that sort of guaranteed profit to be allocated. And that's why the conventional old boy system hates it. And people are going to look back and say, gee, why did we ever put up with that for so long?
I think you're totally right. We've been doing it with this one way for 100 years. Let me ask you something, Patrick. You're Elliot Spitzer, okay? There's a cartel that sets the price between 6 and 7%. This deal, doesn't it show you that the cartel is a useless, monopolizing entity that extracts wealth out of people who typically only go through it once and therefore don't know any better?
Absolutely, and I think that's probably an insult to cartels. I mean, these people are worse. I had people threaten me that if I went with Handbrake, I had all the banks tell me, I'll work with any other bank, but if you go with Handbrake, we'll never pick up analyst coverage on you. That was one of the ways. I don't negotiate with terrorists. As soon as they told me that, I said, I'm going with Handbrake. But Elliot's, you know, it's a useless cartel that extracts rents by shoveling underpriced IPO allocations to their buddy in some sleazy hedge fund, and then the hedge funds give them the kickbacks. That's why in the last couple of years you've seen these banks paying $100 million and $1 billion fine in one case, and there's one guy who's on trial right now in New York for doing this stuff.
Mr. Byrne, let me ask you this. a lot of folks have said, oh, if we had Dutch auctions, this would avoid the bubble. I understand how a Dutch auction will make sure that the company gets a lot more money that they left on the table. But doesn't this also make a lot of individual investors possible to be suckers and getting in really early and paying way too much at the beginning, just like they did back in 1998 and 1999? They're not going to be anything preventing them from getting in.
Well, I understand your point, but what the individual investor who thinks they're going to get in on some IPO that's going to triple in the first week, they should stay home because it's not going to happen. If there's that kind of demand, to begin with, the auction is going to find it.
Almost done, so it shouldn't be more than just a minute over time.
Now, I've worked with Hambrecht. I did it once. They will price in a 5 to 10% tailwind, so everybody understands it comes out of the gate and it trades up a bit. But the guys who are in there to get a flip should stay home because they're not going to get it. Therefore, the only people who bid should be the people who understand the business, like it. They're not getting in because they think they're getting some piece of paper on an uptick. They're not day traders. They're people who understand the business and think that it's a reasonable price.
Thank you, Patrick.
Thank you for having me.
Man, don't ever change. Stay the way you are. They haven't gotten to you yet.
Never.
Patrick Byrnes, CEO of Overstock.com. Thanks so much.
All right. So, yeah, as you can see, interesting debate there. We'll continue this discussion on Tuesday. So have a great weekend, and I'll see you all on Tuesday.